Now speaking, Richard Galanti, Director, Executive Vice President, and Chief Financial Officer. Third quarter earnings reported a net income of $1.30 billion, or $2.93 per diluted share, compared to $1.35 billion or $3.04 per diluted share a year ago. These results included a one-time charge of $298 million pre-tax or 50 cents per share, primarily for the discontinuation of charter shipping activities. Comparable sales for the quarter were 0.3% on a reported basis and 3.5% excluding gas deflation and foreign exchange (FX) impacts. E-commerce revenue was down 10% on a reported basis, but down 9% excluding FX. Traffic or shopping frequency increased 4.8% worldwide and 3.5% in the U.S. Average daily transaction or ticket was down 4.2% worldwide and down 3.5% in the U.S., impacted by weak non-food discretionary items. Foreign currencies negatively impacted sales by 1.5%, and gasoline price deflation impacted sales by 1.7%. Membership fee income was $1.044 billion, or 1.98% of sales, up 6.1% from last year, 8% excluding FX headwinds. Renewal rate was 92.6% in U.S. and Canada, and 90.5% worldwide. Membership growth continues, with 69.1 paid households and 124.7 million cardholders as of the end of Q3, an increase of 7% from a year ago. Executive members now represent 45% of paid members and 73% of sales. Gross margin was up 13 basis points from a year ago, but down 3 points after factoring in gas deflation. Core merchandise margins were up 39 basis points on a reported basis and 24 points ex-gas deflation. Ancillary and other businesses' gross margins were higher by 13 and 9 points respectively. 2% reward margins were higher by 11 and 9 points respectively. SG&A reported was up 49 basis points from a year ago, and 34 points ex-gas deflation. Operations was higher by 48 and minus 35 points respectively, Central was minus 11 and minus 9, stock compensation was 0 in both columns, pre-opening was minus 1 and 1 point respectively, and other was plus 11 and 11 points respectively. Interest expense was $1 million over last year's $35 million number, while interest income and other was higher by $57 million due to higher interest rates and cash balances. Tax rate in third quarter was 26.5%, compared to 24.9% in Q3 last year. Net income was down 4 percentage points from a year prior, but would have been up 8% if reflecting the higher tax rate. 17 locations opened in first 3 quarters with 9 new openings and no relocations planned for fourth quarter, bringing full-year account to 23 net new locations, composed of 13 in the U.S. and 10 international. UBS analyst Michael Lasser inquired, how is Costco planning to use price cuts to drive traffic and sustain mid-single-digit comp growth while managing the potential of deflation across its product portfolio? Richard Galanti replied, our team works hard every day to ensure our members get the best prices possible. We have had to adjust strategies, such as discontinuing containers and shipping vessels, in order to stay competitive in a challenging inflationary environment. Despite deflation in gas prices, we continue to take measures to reduce costs and drive sales across all categories, from fresh foods to non-foods. Through careful diligence and collaboration with our vendors, we remain one of the most competitive warehouse clubs on the market. UBS analyst Michael Lasser inquired, are you expecting broad-based deflation, Richard? Given the value you provide to your members, wouldn't it be beneficial for your company to raise fees in light of your high renewal rates and the current economic climate? Richard Galanti replied, on the question of deflation, while we hope it does occur, our primary focus right now is to ensure that we don't have an adverse impact on renewal rates or sign-ups with any changes to membership fees. We want to be a beacon of light for our members and are confident that we have enough leverage in place to drive business without changing our fees at this time. We will keep everyone informed as soon as we have more information. Morgan Stanley analyst Simeon Gutman inquired, Richard, could you provide an overview of the factors that have contributed to the slowdown in comps and stacks over the last 3 years? Richard Galanti replied, we have seen a growth in traffic and customers are buying non-discretionary items such as fresh food, sundries, apparel, and patio furniture. Consumer electronics sales have decreased overall, but our numbers have declined less compared to the industry. We are focusing on bringing in more food and sundry items that are priced between $15 to $25 to capitalize on the increased foot traffic. Our staff and merchants are being proactive to make sure we capitalize on this trend. Morgan Stanley analyst Simeon Gutman inquired, can you provide an overview of the gasoline gross profit trends year over year, including gallons sold and penny profit? Richard Galanti replied, gasoline sales were close to flat for the quarter, with an average price per gallon that was 11% lower than last year. Despite this, gasoline remained profitable in both quarters, though not by a large margin. We experienced a strong performance last year in Q4 and, with an extra week this year, we're hoping for a similar result. J.P. Morgan Chase & Company analyst Christopher Horvers inquired, could you please explain how your current pricing strategy is responding to market deflation and how you are balancing the cost of promotions between retailers and vendors? Richard Galanti replied, in working with our suppliers, we look to maximize our buying power. We commit to longer-term contracts to minimize price volatility and negotiate for promotional dollars from our suppliers. We also use multi-vendor mailers and temporary price discounts to drive sales. Further, we look to understand the elasticity of demand when considering price changes. All of this is done with an eye towards understanding the consumer and driving their engagement with our products. J.P. Morgan Chase & Company analyst Christopher Horvers inquired, given the current market conditions, what strategies have you implemented to ensure that your company is able to continue to compete and remain profitable in the face of potential inflation? Richard Galanti replied, well, when there was low inflation and not an overarching concern about a recession, we were outperforming most peers in terms of sales growth. Our success is due to strong member loyalty and our ability to offer the best prices, quality products, and a wide selection of goods. We've also compared favorably against those experiencing weakness in discretionary items. Furthermore, we've seen a large surge in sales for indoor and outdoor furniture and electronics over the last 2 years, making it challenging to compare year-over-year performance. Despite this, we remain confident that we will come out of this period well as we continue to introduce new and exciting products to our customers both domestically and globally. Truist Securities analyst Scott Ciccarelli inquired, good afternoon. Richard, based on the data you mentioned, what is the cause of the softer sales in fresh foods? Is it due to members opting for less expensive packaged goods or is it mainly attributed to COVID-19 comparisons? Richard Galanti replied, yes, in the quarter total company sales were 0.3%, of which 3.5% excluding gas and FX. Fresh was mid-singles, food and sundries mid to high singles, and non-foods was slightly negative at over mid-single. Truist Securities analyst Scott Ciccarelli inquired, are you seeing any evidence of customers trading down to private label products in response to the current market conditions? Richard Galanti replied, but yes, we've seen some of that. Yes, we've seen a shift from beef to poultry and pork, as well as an increase in private label sales penetration. Over the past 10 years, we have seen an increase of around 300 basis points, with a particularly large jump of 120 to 150 basis points in the last couple of quarters. This suggests that shoppers are looking for better bargains when it comes to their groceries. We've seen people upgrade to Kirkland Signature products, which can be seen as an upgrade. Credit Suisse analyst Karen Short inquired, my question for the earnings call is, could you provide some insight on what led to the high pre-tax margin, and how could a deflationary environment impact your EBIT line? Richard Galanti replied, in our view, deflation presents an opportunity for us to lower prices and drive business. We have higher profitability than competitors and the price gaps between us and our competition remain strong. Pre-COVID SG&A was around 10%, and with COVID our margins improved and we were able to get down below 9%. We are confident that even with lesser top-line sales, we can pull the levers to drive bottom-line performance. Going forward, we will remain pragmatic about deflation and wage pressure while continuing to prioritize taking care of our employees. Credit Suisse analyst Karen Short inquired, could you explain what impact a change in sales volume would have on the company's EBIT? Richard Galanti replied, our collective view is that in order to remain profitable and maintain flat expenses at the warehouse, we need around 4.5% of incremental sales. Despite the weakness in big-ticket items and the deflation of gas prices, we have still seen improvements in labor productivity in terms of pounds of protein processed through our system and in front-end labor hours. As a result of wage increases, our single biggest SG&A item may be higher than expected as a percent of sales. In the end, we are still a top-line company and we expect that this will mend all things. We hope to return to a pre-inflation range of 5 to 8%, but for now we are striving to reach 3 to 4%. Furthermore, our compares should be easier 6 months from now. Guggenheim Partners analyst John Heinbockel inquired, Richard, could you please tell us what factors drove core-on-core growth and is the erosion of fresh food sales close to being stabilized? Richard Galanti replied, yes, our fresh foods have seen an increase in margins year over year compared to 2019. Richard Galanti replied, fresh food margins for Q3 this year are up versus pre-COVID levels. In comparison to last year, they are down slightly, but still up significantly from pre-COVID levels. We saw a huge surge in fiscal 21 with fresh food margins increasing 200 to 300 basis points year over year. This year, we have leveled off at 50 to 120 basis points down year over year. Overall, our food gross margin is higher than pre-COVID levels. Guggenheim Partners analyst John Heinbockel inquired, can you provide insight on the breakdown of revenue growth from mix, private brand and less big-ticket items? Richard Galanti replied, yes, our performance is mixed. Apparel has a strong margin and majors have a weak margin, which leads to lower penetration. Additionally, freight has been beneficial to big-ticket items such as furniture, white goods, and exercise equipment. Guggenheim Partners analyst John Heinbockel inquired, what progress has been made on the personalization journey, in terms of data analytics, loyalty programs and targeting promotions to increase wallet share? Richard Galanti replied, I'm pleased to report that we have made significant progress in our personalization efforts. We have invested in hiring a new VP of Digital to oversee the transformation of our e-commerce website and mobile apps. This is supported by an engineering team, data analytics team, and business users. As a result, we have been able to improve our primary e-commerce website and mobile apps. We are also now on track to roll out small improvements to our mobile app each month going forward. Although we are still in the early innings of this process, I am confident that we will be able to report more positive news in the upcoming quarterly call. Cohen & Company analyst Oliver Chen inquired, Richard, could you provide insight into the trends in household income you're seeing among your customers and how it might be impacting your inventory planning? What are your expectations for big-ticket item purchases and how they may evolve sequentially? Richard Galanti replied, our annual household income has increased slightly, which is likely due to wage increases. We still target higher-end consumers and we remain focused on that segment. Previously, our inventories were up 26% year over year, largely driven by a combination of consumer demand and supply chain challenges. Since then, we have reduced our inventories significantly. To reduce some of the overstock, we offered promotional activities, such as cash cards for purchases of $3,000 or more on big-ticket items. With regard to air conditioners, we anticipated selling $500 million, but due to supply chain delays, about 20 to 25% came after the summer season. After discussing with our head of merchandising, we are pleased with our current inventory levels and what has been committed for upcoming seasons. Cohen & Company analyst Oliver Chen inquired, Richard, what progress have you made in Asia and other regions in the last 6 months? What strategies are in place to deliver your members an optimal connected consumer experience between digital and physical channels such as BOPUS and curbside? Richard Galanti replied, yes, calendar year. So that's 6 and 19 in China, and then we've got a pipeline of probably another 10 to 15 over the next couple of years. I expect our expansion outside of North America to continue with steady growth as we open new units in Korea, Taiwan, Japan, Australia, Europe, and especially in China. We have already opened 6 units this year in China and have a pipeline of 10 to 15 more over the next couple of years. Richard Galanti replied, yes, we are continuing to grow our brick-and-mortar store count. We plan to open 23 to 25 stores this year, 2 more in the current fiscal year and 1 more in the fall. We are confident that by the 6th through 10th year, we can reach a goal of 25-plus stores annually and even closer to 30 per year. As for curbside pickup, we've tested it and found that customers come in to pick up orders and over half end up shopping while they're there. With Instacart, we have same-day grocery delivery, as well as 2-day dry goods delivery. This number is not reported in our income numbers as the contract employee comes in, shops, rings it up, and then delivers it to the customer. Our 5 Capital analyst Scott Mushkin inquired, what promotional activities have you seen in the market, and how are you addressing them? Richard Galanti replied, yes, we are seeing a higher demand for our products compared to the past few years. This is due to supply chain challenges where we had to limit certain items per customer due to shortages. We also had to remove some items from our MVM mailers and sundries side in order to cope with the shortage. However, we are now in a better situation and our demand has increased. Our 5 Capital analyst Scott Mushkin inquired, can you provide insight into whether the increased sales are primarily driven by vendor activity or retailer activity? Richard Galanti replied, we are monitoring the market and our suppliers closely for any unusual activity. We have a variety of levers to pull to remain competitive, such as leveraging gas prices, fresh product and apparel margins. This has enabled us to maintain strong performance in these areas. Our 5 Capital analyst Scott Mushkin inquired, "What is your question for the quarterly earnings call? How does Costco plan to maintain its competitive edge in the face of increasing competition over the next 1 to 3 years, with particular regard to their omni-channel technology and e-commerce capabilities?" Richard Galanti replied, "We are fortunate to have a substantial competitive advantage when it comes to providing our customers with the highest quality goods at the lowest price. Our average markup on goods is typically in the low double digits, which is significantly lower than most traditional retailers who range from 25 to 35% to 100%. We have also identified some previously overlooked opportunities, such as personalization and target marketing, that we plan to capitalize on. Additionally, while other retailers see value in online purchases with in-store pickup, we view this as more costly than beneficial for us. We intend to grow our online sales by incrementally increasing our digital presence over time. Finally, we are investing in our merchandising and technology capabilities to take advantage of additional advertising dollars and drive sales." Richard Galanti replied, "We are on track to reach our goal of opening 25 to 30 new units each year over the next 5 to 10 years. We have a robust pipeline of pending openings for the next 3 to 4 years and confidence in our ability to identify additional opportunities to open units." Citi analyst Brandon Cheatham inquired, "My question to you is, how do you see the balance between your digital investments and the loyalty of your warehouse members impacting your long-term growth?" Richard Galanti replied, "Our digital and warehouse monetization efforts are bearing fruit. We've made great strides in promoting our products, such as steaks for holidays and planning supplies for the season. To further this success, we have hired Senior VP Sandy Torrey to focus on membership marketing and other initiatives. Technology is increasingly important for businesses, so we've made a strategic effort to stay ahead of the curve with analytics, data, and digital capabilities. We have brought on experts to facilitate this and are continuing to invest in these areas. We now have tailored emails to customers based on their store purchases, which has increased click-through rates. This is just one example of how we're utilizing technology to drive business both online and offline." Citi analyst Brandon Cheatham inquired, "Can you provide an overview of how your membership marketing strategy differs from that of your competitors, and whether or not you have adjusted your promotions in response?" Richard Galanti replied, "Our membership has seen a 7% year-over-year increase, and we have opened just under 3% of new warehouses. We attribute this success to our product offerings and services, as well as the fact that during COVID, our warehouse clubs provided a safe, cavernous shopping experience. We do not heavily discount our memberships and keep promotional activity to a minimum." Oppenheimer & Company analyst Rupesh Parikh inquired, "Have you seen a bounce back in sales for locations that have reopened?" Good afternoon. Thanks for taking my question. Can you please provide an update on the performance of your reopened locations in China compared to your expectations? Have you seen a recovery in sales?" Richard Galanti replied, "Our members have been responding favorably to our initial reopening efforts. We've seen strong engagement with our care packages, which were well received in the communities we serve. Our team put in a lot of effort to ensure they included the best items that our members would appreciate, and we believe this has contributed to the positive response we've received." Oppenheimer & Company analyst Rupesh Parikh inquired, "Could you provide us with an update on whether trends have bottomed out in the bigger ticket categories, such as consumer electronics?" Richard Galanti replied, "My colleague on the merchandising side noted that we have seen a decline in our numbers 7 or 8 months ago. However, compared to 5 months ago, there has been slight improvement and we are optimistic that this trend will continue." Richard Galanti replied, "Thank you for your question. David, Josh and I are available to provide any additional information you may need. We appreciate your interest in our company and we look forward to continuing the conversation."